Hi everyone, I'm Akshara Menon from PMS Bazaar. I'm thrilled to welcome you all to the Friday webinar on uncovering high growth opportunities as market scales new heights. With markets hitting new peaks during this bull run, today's discussion wouldn't be more timely. We will dive into how to uncover those high growth opportunities as it is essential in navigating in dynamic landscape. Our focus today will be on several areas. First, we will explore the leadership qualities that drive sustainable growth, manage risk effectively, and maintain strong governance. We will then shift to recognizing the sectors with significant potential and healthy competitive dynamics. Understanding these sectors will be effective in leveraging the market's upward momentum. We'll also discuss how to navigate the current market outlook using the smart sector rotation techniques, followed by a deep dive into Ampersand's unique investment philosophy, particularly when it comes to selecting the stocks with right stocks, right time, and right size. Lastly, we will touch upon how to build a resilient portfolio that consistently delivers returns, specifically through the lens of Amazon growth opportunities. I'm honored to introduce Mr. Arun Subrahmanyam, our speaker for the day. With over 25 years of experience in equity research, Arun has been recognized as a top-rated analyst by the Institutional Investor and Asia Money. A graduate of St. Stephen College, New Delhi, and qualified chartered accountant. Arun has held significant role, most notably as a managing director of research at Bank of America, Merrill Lynch, where he worked for 11 years before founding Ampersand. This deep belief in fundamental equity research has been a cornerstone for Ampersand's success. Welcome to this webinar, sir.
Thank you, Akshara. Thank you for.
So today's session, we'll be having it more interactive and we encourage more participation from you. Our Q&A will be divided into three segments. First, we will tackle the questions around the market and strategy. Then we'll be switch upon the rapid fire round, testing to bring the quick insights. Finally, we'll have a section called "Person Behind the Profession," where we'll go to know more about Arun, more on his personal level, decoding the fund manager behind the strategies. Throughout the session, you can have if you have any questions, feel free to put them on the Q&A box. Just a gentle reminder to avoid stock specific questions. And without any further ado, let's begin the quick PPT from you, sir.
Okay, just a second. I'll just. So this is actually a detailed presentation, but I'll just focus on a few slides which relate to what Ampersand is, who we are, our investment philosophy, and a little bit on what we have done so far. So, like you actually pointed out during the introduction, me and my team, we are a team of highly rated equity research analysts. Both me and my partner Sanjay collectively have an experience of more than 40 years in equity research. That's been our entire career so far before we started this fund. We started in 2017, and since then, we're actually going to be finishing 7 years this September. Our performance has been quite consistent, and we have been ranked in the top quartile amongst peers. This is as per the CRISIL study, which does the benchmarking exercise for us and all our peers. The third aspect is that the fund itself has significant sponsor contribution, which includes me and a couple of our partners. So that obviously highlights the high level of commitment which we have for the fund. So these are primarily, this is primarily what we stand for. Coming to what we manage, currently we are managing a single scheme, which is a Cat 3 multi-cap scheme. Like I said, it was launched in September 17. It's a growth-oriented scheme. So we obviously targeting companies which score on growth. And it is an open-ended fund. In fact, it was one of the few open-ended funds which was launched in 2017. Most of the funds which actually came in then were closed-ended, but we were one of the few which actually were open-ended. There is a lock-in for 12 months, and then thereafter you can redeem at any point in time. And like I said, it's a multi-cap scheme, so we have a fair mix of both all three large, mid, and small caps. Um, as you know, AIFs, the returns are tax-free in the hands of the investors because the AIF takes care of the tax for the investor. And as per the mandate, minimum contribution is 1 crore, and top-ups thereafter can be less than 1 crore. So this is our kind of philosophy and strategy how to actually deliver superior returns. Essentially, what we try and do is to buy the right stocks at the right time and the right size. I mean, I know it's a very simple kind of statement to make, but usually it's the toughest thing when you actually get to trying to combine all three. And what we try and do is that by doing this, try and consistently outperform by delivering better than our benchmark returns. Our benchmark, incidentally, is the BSE 500, but internally we have much more stringent targets of achieving returns for our investors. Right stock, as you obviously know, is obviously buying the right company. And what constitutes right stock for us, where the management quality is extremely good. The company also operates in a segment where the market is very attractive in terms of the addressable size and how the company is competitively positioned to grab the market to gain market share in that market. And finally, the company should have a sound business strategy which enables them to do so. In terms of timing, obviously it's the most difficult thing to actually get the right timing. So what we typically try and do is to buy stocks at the bottom of the cycle, and then obviously try and ride through the cycle and maybe exit when we believe that the cycle is reaching its peak or has reached its peak. And the peak would be typically measured by growth either slowing down or margins starting to contract. So that's for us would be the cycle which we would like to play. So that's the in terms of timing. In terms of size, again, if you've got the right stock and you bought it at the right time, you also need to ensure that the size of the holding is appropriate given the rewards you are expecting from the stock you've invested in and the risks that it is. So for us, the right stock would be one where there's an optimal allocation of weights, both maximizing returns and minimizing risk. Then coming to our fund, how it is done. As you know that we are finishing 7 years as in September, so we have got returns as on August 31st, which is end of last month. You can see here, I don't want to rattle off the names numbers, but you can see here, we have been quite consistent. I mean, yes, the last 1 year has been exceptionally good, but we are more proud of the fact that we have actually been more consistent, not just over 1 month or 6 months, but over 3 and 5 year periods as well. Since inception, a 26% return, which you see there, compared to our benchmark, which is the BSE 500, and the other indices, you can see the amount of alpha which has been generated by investing in our fund. These returns are essentially post fees and post taxes on realized gains. If one were to include the unrealized gains, which is a notional number, the returns would fall by about 80 basis points or so. So that will still be more than 25% over a 7 year period. Yeah, this is in terms of consistency. As you can see, every year there have been years where we have not done well, but it has still been better than what the market has done, and what the benchmark and what better than what the benchmark has done, and better than most of our peers. Yeah, I think I'll stop here because the rest of it actually contains a lot in terms of describing each element in more detail. But I'll leave that to Akshara to ask questions, and I can go with the answers.
Thank you, sir. That was in a very quick PPT indeed. So as discussed first, so we have these three segments to go. So we'll start off with the very first segment, more on market now. So to start off with, the speculation is going around is the US Fed ka potential rate cut that can be incorporated by the RBI aspect. So how do you expect the rate cuts to move, and what is the impact that will have on your funds?
As far as we are concerned, I mean, we don't think too much about what the Fed is going to do and what the RBI probably will do after that. But from our point of view, I think we are kind of factoring in a shallow rate cut. Nothing because it's actually good for markets if it's shallow, which obviously means that there will be a soft landing, and that's what we've actually factored in our assumptions, and that's how we have actually gone about making our investment decisions.
Okay, so the one question is that as U.S. elections are fast approaching, and that is the next big event market is looking upon. So, what do you think that will have an impact? Will that be a biggest challenge for the equity markets in this 2024? If at all, if there's any challenges, what should the investor be aware
See,
of?
you see, that's an event. I mean, obviously, there will be certain policies which may have a bigger influence on how U.S. markets will behave, and to some extent, it will affect our markets too. But the bigger challenge, like you said, is in terms of what the Fed is going to do and how the economy is going to behave thereafter, depending on what are interlinked, of course. So that's the bigger challenge as far as our investments are concerned, not so much the outcome of the US elections.
Also, we can't trust the poll that is running by. So it can be, it can be a 50-50 chance, either for Trump or for Harris. Can be either ways chance. So will that, who will be good to the market? It's a very, I know it's a out of the box question.
Yeah, okay. You're asking me the same question in a different way, but I'll tell you. No, no, I'll tell you. See, when even India had its elections in April and May, you know what the poll said, right?
Mm.
And obviously, the poll ultimately turned out to be right, but the numbers were very different.
Yes.
And you know how Indian markets reacted, or thereafter they actually kind of overlooked the outcome and moved on. So ultimately, it's all about growth. It's all about the economy, how the companies are doing, and how stocks are doing, and how the relative valuations stack up. That's ultimately what matters. So, like I said, these will happen and they will pass, and after that, you'll basically be down to business and starting to look at stocks the way they should be.
True. And being into your multi-cap, and yours is a multi-cap, but that's more focus on large caps, which has a more focus on large caps. And how do you, like when your peers are giving more weightage to small and mid caps now, so how do you see the space on large, mid, and small?
So, yeah, our multi-cap fund, the way it's actually been made our allocation to stocks, you're right, it's about large caps, but our large caps are not Nifty weighted. They're mostly junior Nifty or thereabouts, and many of them are actually, not many of them, some of them are actually were mid caps a year or two ago, and they have turned to be large caps. First, they go through a transition of getting to the junior Nifty and then becoming Nifty stock. For example, Trent, which was a mid-cap stock when we invested, today is part of the Nifty. So that's the reason why you probably see some of our preference to large caps. Not that we actually prefer to invest in mid-caps or smaller names, which can become part of the junior Nifty or the Nifty. That's basically how we target our companies, and that's how we have allocated our resources. So it's not really true that we target large caps. We actually target the smaller companies. If they remain small, I mean, it's obviously we've not done our job correctly, and And so essentially, most of the small and mid caps we own, we hope that at some point in time they'll become part of the larger
Large cap.
birds. Yeah.
Yes, sir. That was my, then the following up question was like about the trend, which is one of your top holdings as well. And also that's getting entered into the Nifty 50. So when did you find this? Like, because the whole webinar is on high growth, finding the high growth opportunities in the market. So
Yeah.
when was the time that you found trend, and when did that enter into your portfolio?
Yeah. So, I mean, specifically, we got in, I think, in November 20, I think. That was or maybe before that. Let me think. Yeah, it was November 20. It was November 20. It was post-COVID. And obviously, the entire sector was under stress. And we played it on the reopening theme. And obviously, we needed to invest in a company which had a good pedigree and had plans to increase its store count. And basically, we believe that this is a company which can execute, if they have the capability to execute and grow in a market which we really at that point in time didn't know how much it will, how fast it will grow. And as it turned out, if you look at, I mean, this is something which we didn't know in 20. We knew it will do well, but we didn't know it will do as well as it did. Because if you go back into the last 4 years, it's actually done remarkably well, considering that most of its peers, including names like DMart and all that, they haven't really shaped up the way the markets wanted them to. And that's what actually stood out for trend. And that's one of the reasons not only has the stock done well, but it actually trades at such valuations where people always express surprise as to why one should be paying so much for a company. So, I mean, like, if you had asked me 4 years ago, will it be a 10 bagger? I would have obviously said no. Then I otherwise I'd have put much more into trend than I did then. But yes, we knew it will do better than most companies within the sector, and that's why we invest.
Okay. So let's say that. So one more, the top five holdings that you have is Zomato, which is which is more having its market share around and most of the investors are in buying stage for Zomato. So what is that one thing that you feel about positive about Zomato's stock? And this is no any recommendation neither from Ampersand or any Peerless
No,
Bazaar
no.
as well. Just want to
Yeah.
know about it.
So Zomato, you didn't ask me when we got in, but that's good. I'll tell you myself. See, we got it much later. I mean, we didn't get in as at the bottom or the bottom. We just got in a year ago, which was around 100 or thereabouts. By that time, it was obviously a great. The theme was good. It was something which attracted us. But more importantly, it was again about how the management, how the clarity in terms of what they plan to do and how they plan to grow the business. So we went by that. Of course, if you had gone through the numbers, you wouldn't have at that point in time thought it is a great investment. And the numbers have started only coming in the last couple of quarters, right?
Yeah.
And it's also been triggered by this acquisition which they made of Blinkit, which has been this remarkable thing for them because they've actually gone into the quick service model. So that's the second thing which actually then started seeing momentum in the stock. And of course, there are many more triggers. I mean, obviously, when the management now they're actually getting into this ticketing business, and so they're expanding. They're using their capital, allocating capital to the right areas. So I think it has a long way to go. And again, it's a company which you cannot see just by valuations. It's a business which has a huge opportunity, and it's obviously run by a group which understands the business and knows how to execute. So that's the reason why we continue to hold it.
I know this guy. Do you see any potential multi-baggers in Zomato? Do you think it will be a multi-bagger soon?
See, it has been a multi-bagger for people who have gotten before we did. It's been a multi-bagger or whatever. But the thing is that in terms of the opportunity is huge. I mean, it all depends on what the time frame is. For us, anything we invest in, we look at 3 to 5 years. we don't know how well the company is going to do, but we know that there's a market which is there to be there's a market which can be tapped, and if the executions if executed well, the company can really I mean the stock can really do well.
Okay, so I think one question from the audience. There was one question, Saurabh, is that while the fund is a multi-cap fund, have you had been more in small and micro cap heavy to deliver a great and consistent returns for past 7 years? Also, do you believe that you will need to do something different in next couple of years with small caps being overvalued?
Okay, I'll break it into two parts. In terms of, see, we first of all we don't invest in micro caps. I have nothing against them, but we don't invest in them because the nature of our fund is that we are a multi-cap fund. Although we are market cap agnostic, we also, when we look at es- essentially any company we target is our growth-oriented companies. In our heads, we think that any company or any stock which can deliver, which can become where stock can double in a 3-year time frame, largely led by earnings. We go ahead and invest in that stock. By that count, yes, you can obviously say that a lot of the small and micro caps have that had that criteria. But at the same time, you also need to be cognizant of the risks of investing in these very small and small companies. I mean, i.e., in terms of the management, you're not very sure the track record, also the stock, whether how liquid it is, and things like that. So we balance both in terms of not just in terms of size of the company, but also in terms of various other parameters before we actually go on to invest in a company. So our historically, we have not had a portfolio which is skewed in presence of small or mid or other way around. You already introduced that we invest in large companies. We basically try to maintain a balance of small, mid, and large. It's just that some of the small, when they turn mid, we get into more small. Some of the large, which become so large that we cannot, then the growth starts to taper off, or there is the potential returns start to mutate.
Yeah.
Then we obviously exit those stocks. So that whole cycle is about getting into smaller companies, which then become large, and then just going through the cycle again and again.
So one more question from the audience is that if you could, give the split between large, mid, and small cap and the rationale behind it.
Yeah. So see again, when we design a portfolio, we would typically like 40 large, 40 mid, and 20 small. That's that's really design. But the fact of the matter is that these keep changing. If the mid does better, then mid proportion goes up. Small does much better, then small doesn't stay at 20, it goes to 30. So at the present time, it's probably equally split between the three.
So regarding the sector rotation, is there any sector that you avoided earlier, but you're interested now? If you could give that an example.
So we have avoided PSUs. We have avoided commodities, pure commodities, basic commodities. So in terms of PSUs, we have not really. We have a couple of PSUs, not a couple, just one PSU we have in our portfolio. We bought it more because it fitted a certain theme which we were invested in, and that was the energy transition theme with that fitted into that theme. So we bought that. Otherwise, we typically don't invest in PSUs. But having said that, there are some good PSUs. So you can obviously argue for a fact that if you had invested in Hindustan Aeronautics, which is part of the defense space, which was a roaring theme in the last 3 years, you would have made tons of money, and it has long legs of growth going forward. We didn't invest in it, but we got into defense through something else. We got into railways through a private company. So we have got into those themes, but we prefer to do it through private companies than to do it through public companies, government-owned companies. So that's not going to change. I don't think we are changing. Even in the last 1 year, we have made changes to our portfolio in terms of reducing our exposure to industrials. But we have got back, we have stayed with the basic philosophy of sticking to not investing too much in PSU, hardly investing in PSUs and not investing much in commodities.
So, what is your view on PSU banks?
I mean, we don't invest in it. So anyway, uh, let me say, thing is that obviously it had value a year and a half ago, and that value has been realized. I mean, all of them have got re-rated, but fundamentally we know that if you look at public sector banks compared to private banks, the positioning in terms of how private banks can do, private banks obviously stand a much better chance uh, uh, of uh, of growing over a longer time frame. But like I said, I'm not a bank expert into trying to give you a treatise on bank or public versus private. But we didn't invest in public sector banks, just like we didn't invest in many public sector companies.
Yeah. So, but one of your holdings also has ICICI. Just correct me if I'm wrong, because you had
Yeah,
ICICI Bank into your thing. So
right.
so this fund has been categorized more into this private sector banks. So where do you see
Uh,
valuations there?
yeah. So the valuations are okay, but in private sector banks, the entire banking space has actually done very poorly, right? So valuations are looking okay, but there's a reason for why they are doing poorly. There are lots of reasons. I mean, like I said, instead of getting to each reason as to why banks are doing badly and how they will do going forward, our basic call is that if there are sectors outside the banking space which can deliver higher returns, even allowing for some premium valuations, we will prefer those than to get into lenders or banks and NBFCs. We prefer the non-financial space to the financial space, but we cannot ignore the financial space altogether. So the way we have got into financials is to get into the non-lenders, some of the the asset managers, the wealth management companies, companies like those we have actually gotten, and that's how we have actually um, uh, generated the returns we have so far.
So when you talk about valuation, so because you have the top five holdings, we have a few new age companies also. You have some traditional companies also. So how do you evaluate valuations between these new age companies coming in and the traditional companies?
See, it all depends. See, it all depends on how you define new age, because there are so many companies which are new age. But new age, by definition, means that there is no benchmark. You set to how to value those businesses. You will have to look for such businesses which have possibly traded outside India, and then then try and build some case for setting valuations. Um, Zomato was a new age company. It, such companies didn't exist in India till some time ago. So valuations is a tough call to start with as a starting point for such companies. It's the opportunity of such businesses and the ability of companies to achieve that. What are the strategies in terms of achieving that? To grow in that space. That's how we'll probably like to believe we will try to invest in new age, in such new age companies. The traditional companies we already know. I mean, there are lots of cases as to we've known how these companies have traded, what kind of cycles they follow, and things like that. So it's not a very difficult one to track.
And also when you talk about the market, when market is having new highs every day, there's one biggest question among the investors, that should we wait for the dip for the market or should we invest now? So if such confusion, how do you answer that?
You see, you if you want to be invested in markets, which one should, then you should invest and then wait for a dip to invest more. It's a simple thing. I mean, now obviously this whole question which you're asking me, lots of people have been asked this question, and I've been asked this question several times. I mean, with every passing day, I, I don't know how to change the answer, except the fact that yes, the index yesterday was something and today is something more, right? So one, that assessment whether to invest at such high valuations, is it a good idea? Well, obviously everybody wants to buy stocks at a lower price. But if you don't get it, and if you believe that the the markets in their own wisdom, or where in terms of what the opportunities are, will continue to do well. Not just, I'm not talking about next 3 months, I'm talking about it over a year or 3 year period. Then it doesn't really matter. Everything evens out. If you, like I said, if you buy some just now and some at a possible dip, or some more at a bigger dip, it's great. But over a 3 year or 5 year period, everything evens out. It doesn't really matter. Either you make X or you make X plus something else, or X minus something else. It doesn't really matter. So at this point in time, I would think you should invest, but be prepared for a fall, or a correction of 5 to 10%. That's not big deal.
So no one can time the market. The same thing.
No. Yeah, no one can time the market. But like I said, to start believing that markets will fall, so I will wait for a fall. That is also not a great idea, right? If you see, these Indian markets are investment worthy, given the macros and given where we stand in terms of our fiscal situation, or the stable political government, and the fact that all the corporates are deleveraged, and there's a lot of opportunity to waiting to for this growth to materialize. So that's the reason why one has to invest in the market. The question obviously is, like you asked, whether you invest now or to invest at dip. Frankly, like I said, it doesn't really matter if you take a 3 or 5 year view. I mean, one would be concerned if let's say one was in 2013 or 2008, when we had a very bad fiscal situation. Our financial health was poor, banks were in trouble, and the political climate was not so good. So all that has changed a lot, and that's the reason why we think that even if there are corrections, they would be shallow, or even if they are not shallow, they will be short-lived.
It's like more, don't wait for tomorrow. If you want to invest, you can invest today.
Yeah. Don't wait for tomorrow. But if the tomorrow does come, is something which you should envisage corrections if you were to happen, because anyway everybody's scared of markets being where they are. So you should envisage and invest more.
Thank you. That was an elaborate answer, I would say. And I'll take one question from the audience. Is that this question that you bet more on growth stocks? Do you have allocations to value stocks?
See, ideally, you would like to buy value stocks which grow, which can grow over a period, right? But today there's nothing like value. I mean, most of the stock sectors have gone out of value, except banks, which we've already discussed earlier. So essentially, you decide that you're a growth fund, you're going to get into growth companies, but at reasonable value. It should not be, I mean, but if you think that you're going to get into reasonable value, there are a host of investment managers who are also targeting the same group of stocks. So nothing is available at a value. So you eventually go to growth. And if these growth stocks happen to correct, like you just asked me a few minutes ago, and then they get into value zone, then all the better. But for our purposes, we will target growth, come what may. And if you think that the growth engine is somehow deaccelerating or tapering off or something, we will get out and get into something else.
Okay. So hope that answered. And the second thing is, how do you see earnings for the second half of this year, particularly after the post-election?
Second half, second half seasonally is a good half for India in general. But that's historically been the case. But having said that, this year we had the elections, as I said, and the slowdown which you saw in Q1 was partly due to pullback in government spending. There was a heat wave in most parts of India. Of course, second quarter, you will probably say that there has been a flood-like situation in most parts of India, so that could be affected too. So logically, that should pass, and second half should be better than first half, because government spending will return, the seasonality element starts to kick in, and we don't have those issues which we had in first half. plus the fact that the monsoons have been good this year, unlike the last couple of years, where you didn't get the benefit of H1, H2, seasonality, you didn't have that benefit. So this year, you should get a better H2 compared to H1, is what I feel.
Okay. So when you talk about stock entry and exit, the philosophy of Ampersand lies in right stock, right time, and right size. So how do you decide it? Right time to entry and right the exit points. How do you decide? Is there any specific business cycle that we are in?
Yeah, that is what I said. I mean, see, ultimately, the right time is to try and time a business cycle. If there are businesses which can, it could be, it could be, for example, there could be interest rate sensitives, which could include a host of building material companies or paints and things like that, which could probably be at the bottom of the cycle. They have not grown at all in the last few years. So we would probably look at them as a case in point to invest in. So essentially, you get into companies where growth has slowed, margins are at a potential low, you will see a long leg of growth going forward. That will be for cyclical companies. For companies which have structural drivers, you really don't have that problem. It's a problem would be that you have to decide as to whether to buy the stock now or you buy on a potential correction, which we have spoken about. In terms of timing, it's all about uh, trying to get into sectors or companies where the cycle is probably at the bottom or near the bottom or has turned maybe. You may not always get the bottom, so you may get it at the early stage of the recovery. That's how you get to the timing size. Exit like I have already mentioned earlier when I was actually talking about my when I showed that one slide. Exits we usually try and do when the cycle we believe has peaked, both in terms of margins and in terms of growth. And there could be other variables whereby we believe that the expectations the market has built into these such companies either the company would not be able to deliver as per those expectations. So that's when stocks tend to typically peak. And we are not saying that we actually sell it at the peak. Just like I said, we are not saying we buy at the bottom. We attempt to do the same both. We attempt to buy at the bottom and try and sell. Sometimes the peak is already passed, and then you're probably selling it when it was coming. Stocks are coming down. But more importantly, we would like to play the entire cycle. That's or as much as the cycle as possible. So we don't try and get into companies which have very short cycles. And that's why I said when you get into commodities, cycles could be quite short. So you buy a particular commodity or group of commodities and maybe for whatever reason, like it happened post-COVID, there were a lot of supply shortages and inventory stocking, and that led to a lot of price increases for commodities. And that played out for about 8 to 10 months. And now thereafter, all these companies, had a very bad ending. So we like to play companies which have longer cycles. So you can buy, even if you're not bought at the exact right time, you buy at right time and then you sell at the right time.
So if I could get some examples, any recent exits from your portfolio?
Okay, so I have an example because in the last 1 year, I don't think we've totally exited many companies. In fact, our stock count has gone up from about 29, 30, which we used to hold a year ago, to about 33 or
33.
34 now. 33, 34 now. So in that sense, we have not exited totally out of too many companies. But I'll give you one example which doesn't really explain this business cycle. We actually got into a railway company a year and a half ago, and it's a very short time. I mean, normally we don't buy stocks for such short periods. But the stock, obviously, the cycle had turned. Railways were getting a lot of orders, which the government was the key provider, and these companies saw that company. These companies in question saw lots of orders coming in, and obviously then they started to target more growth avenues and raised more money and things like that. But the stock, if we effectively, we felt, had a great business opportunity over a 3-year period, but most of it got played out in a year and a half. That's why we actually exited the company. Not that the company's prospects are weakened or diminished. It's just that the valuations were too much for us to kind of accept or to be comfortable with.
Probably that was not into your radar.
Sorry?
Probably that was not into your radar.
No, data, I don't know. I'm just saying that we had a plan of holding on to this investment for a long time, but we did more than that in a much shorter period. So we exited that. I'm very sure we exited a couple of more in that last year, but I'm not be able to recollect. But this is one which is a large holding. It was actually one of the top 10 holdings we had. It became a top 10 holding by virtue of the stocks, the stock going up 6x in the last 1 year. So we exited, and so I remember it clearly. When there are other companies too where we have made some exits. A defense company which we exited, but we exited slightly early. Thereafter, the stocks still continued to go up. It went up about 60-70% even after we exited. So
Okay.
these things have happened. Yeah.
So is there any repent for that because you exited early?
No. What can you do? I mean, yeah, the way to pacify oneself is that you probably invested into some other name which gave you not
Which-
similar, but something, some returns which were in the same ballpark.
Okay, so I'll take one question from the audience. How is it Indian equity market for next 5 to 10 years investment? Like your view on the Indian equity market.
So I have to give an answer because you've asked. But there are people who give this 5-year and 10-year views, and I don't know how much to believe. So I don't even know how much you're going to believe when I say this. So the thing is that, like, if you go back to one of the answers I gave earlier, uh, investing in India over the last 30 years has created a lot of wealth, but it has been very tough. I mean, you've never had periods where you not had an economic issue or something to do with political climate or geopolitics or anything. Everywhere, every time you've had something or the other creeping up. This is the only occasion or this is the only period you can envisage where not only things look good for you, but they look relatively much better than what it was for the rest of the world. I mean, earlier you used to depend on what the US is going to do or what's going to happen to oil or what's going to happen somewhere else, and that's how uh, your markets, your economy, and your stocks used to behave. Today, that's it's been delinked a bit. I mean, I'm not saying for it not totally. So it's to a large extent, I think that's happened. So for me, the next 3 to 5 years look great, and typically anybody who thinks of equities has to think of at least 3 to 5 years, and then we'll take it from there.
Okay. Correct, sir. And when you say this, and also there was one slide in your PPT saying that there are few instances where your fund has underperformed the market as well. So during this underperformance, like when the market underperforms, obviously that will reflect your fund as well. So during this underperformance, how have you shaped your strategy? How different is it from the others?
Yeah. So I will tell you distinctly, we underperformed twice. And like I said, it all depends on what underperformance you're talking about, because we have not really underperformed our benchmark. So, but markets don't care. They look at the best performing index and they say, okay, you have underperformed a small cap index in 2021 or whatever, it could happen. But from our point of view, our underperformance, the one underperformance which we actually we did take some course correction was in 2022, where we had overstayed our investments in IT. We should have probably exited in 2021 or thereabouts, or late in 2021. We cut our positions in IT. to a large extent in mid of 22. So that there was a period of underperformance during that time in our fund, which we so despite the fact that 2022 was a great year for us in terms of picking new stocks, we picked up a stock called Varun Beverages late in 2022, which has been a multi-bagger for us. And the biggest gains came in 2022, and 23 also did extremely well. 24 is not done well. So I'll get to that later. But anyway, coming back to the fact that that is a year, 22 was a year where we actually underperformed briefly for about 4 or 5 months. And we did course correction. We changed our allocation. We exited or partially exited, trimmed, let's put it, IT and got into industrials. And that paid us rich dividends in 2023 and as we speak in 2024 as well. So what we typically tend to do is we introspect, we do course correction. Usually we could be behind the curve by 3 or 4 months if we are going wrong, but we course correct very fast. And that is the reason if you look at our performance, there have been periods of underperformance, as you rightly mentioned, but we have been very consistent over a 7-year period. And that's what matters for us. It doesn't really matter if, I mean, it matters, but it doesn't pain us if we generate 50% returns when others have done 70%. I mean, these numbers are these numbers are anyway very large. It doesn't hurt, it doesn't pain us so much. But as long as we are being really consistent about it, we are okay. Consistently better, then we are okay.
Okay, with that we have come to the end of the first section where we spoke more about markets and your strategy. So let us move to the next section, which is more like a rapid fire round. Apparently, we don't have any hampers to give you, but still, these questions have to be answered fatafat se. Yeah. So the first question I want to ask is that can we expect Ampersand Capital to launch any new fund soon?
Not immediately, but yes, eventually. I don't know whether it's going to be 1 year or 2 years, but yes.
But it is under plan. Yeah. So
yeah, we planned it many times, but the reason I'm saying not now is because our multi-cap fund has a long way to go. And currently, if you look at the way the markets are behaving, it's better to be diversified and be across sector and across market cap categories than to focus on a thematic or a small cap or mid cap. So may not be now, but we probably will look at it at some point.
Okay. So what are the top three sources for your market tips?
Sources.
Yeah.
I'm not in social media, but my partner is. So that's one big source. Then also the fact that both of us have been in this industry for a very, very long time. We have a lot of people who work in the industry, and we have corporate contacts which actually help us in terms of getting some kind of information. And finally, of course, we have empaneled a lot of good brokers who send us research and we discuss with them. And get education in terms of sectors and stocks.
Okay, so next question is that how do you approach investing in highly regulated sectors like pharmaceuticals and financials?
Yeah, it's difficult. Both the sectors you mentioned are difficult. And like I said, that's one of the reasons why we are not in financials as much, although we understand it a bit. But we don't, we'll never be on top of it. If any regulations, regulatory changes and all that, we are not going to be on top of it, and we'll not be able to take appropriate action. So we really don't, we find it tough. So that's the reason why like I said, we've typically been underweight in that sector. I'm talking about financials. Yeah. Pharmaceuticals is slightly, I won't say easier. It also has regulatory issues, and it has these specific lawsuits depending on which drugs can be launched or not get launched, and things like that. That's tricky. That's something obviously we have to depend on what analysts tell us. But otherwise, we go by the same methodology of investing in companies which really have backed by solid management and have a good strategy. Recently we see, this we also like the, other than the generic space, which is a little difficult to track. You also have the CDMO space where we are heavily invested in, where we again go by what the how the management uh, has uh, has indicated its plans to grow the business, and some of them we have actually invested in and done quite well.
Okay. So, what sectors do you think will, outperform in next business cycle?
Okay, it's like asking what is going to do well for the next, how markets are going to do well for the next 10 years. No, no, see, I don't know which sector or sectors can do well, but at where we stand today, it's obviously companies which have sectors which have not done very well in the last couple of years. They could do well. For instance, IT, that's one which could do well. Secondly, there are sectors which were hit by the massive inflation, resulting in interest rate hikes, and obviously, so interest rate sensitives could do well over the next couple of years. Also, companies which were hit by rural distress, that could be a space which could do well for the next 1 2 years.
Okay.
So I don't doubt any.
Correct, sir. So it is a rapid fire. I'm just reminding you again. So rapid fire. Next question is that what was the original vision for Ampersand Capital, and how has it been changed now?
No, 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 nothing has changed. Nothing
What is
has changed.
original? What was the original
No,
vision?
origin this is to essentially generate consistent and superior returns over time, to potentially double your money every 3 years, invest in great companies with where the market and this whole market is huge, and target such growth-oriented companies which have a track record. So nothing has changed. We continue to do that. We have not changed our philosophy. We have not changed the kind of companies we invest in. That's
Okay. So this question was already taken. Let me take this again. So if you were to choose between growth, value, and blend, so what would you choose? You need to choose one. You can't choose all three. You need to choose
yeah,
one.
yeah. So it's if you ask me to choose one without giving a rationale, obviously know it's growth. So
Yeah.
yeah.
Okay. So with that, we've come to another rapid fire also. So let us know more about you. So more about the fund manager. So what advice would you give to your younger self who just started out for investment?
I don't know. I see. I have a. When I see, since you're addressing it only to me, so I talk about myself and not the rest of my team. See, I'm extremely passionate about what I do. I mean, I like markets, and I don't mean looking at markets. I look at US markets. I look at our markets. I look at stocks. I read about companies. I do all of that. So that passion is something which which is something which I I I think something is going to stay probably. And that is something which I obviously advise everybody, not just my younger self or anybody who is young. Don't get carried away by what's happening. The dream run which you have seen post COVID, it doesn't come often. I mean, but we also see cycles. I mean, there have been in the last 20 25 years, we have seen many cycles where markets have had extended spells of downtrend or bearish phases, and those will come. I mean, except that this time around, I think those phases will be much smaller than in the past. I don't know what you asked me, but I just said something. Yeah.
You partially answered my question though.
Right.
So like next question is that can you share any proud moment or milestone that you achieved with Ampersand Capital?
You asked me very difficult questions.
Is it that
So,
difficult now?
yeah. Milestones. Yeah, see, one milestone is doing this webinar. So that's one milestone. Okay.
Okay.
So, no. Jokes apart, I will just say, milestone for us, when we started off, we wanted to touch a certain AUM. But before getting to the size of the AUM, we wanted to get the methodology right, the process right, and how to allocate capital and how to minimize the mistakes in terms of investing. So when we actually started doing that, we realized that we are being very, very consistent in terms of our returns. and we don't need to really worry about what happens to market this week or next month or whatever. So that probably we reached, I think, in 2022. It took us 3 or 4 years to achieve that milestone. The other milestone, like I said, in terms of achieving certain AUMs and things like that, those are happening every couple of quarters or every year. That's been happening. With one milestone, like you asked me on one of your questions, we probably want to launch more schemes, but that is something which we haven't achieved yet, so I won't talk about it.
Sure.
Yeah.
Thank you, sir. With that, we've come to the end of the session. Let me take one last question to the audience, which is that we notice pharma, IT, and FMCG being crucial sectors in near to midterm. Renewables and space for longer time frame are looking good too. Are there any other lesson known niche subject segment to look into the mid and long term?
See, it's pretty similar to what we are actually are. See, consumption is going to stay. I mean, it's going to be a one important theme for India, whichever way you want to play it. I mean, like I said, uh, we've actually tried to play it through the premiumization. A lot of people getting richer, buying expensive houses, expensive travel, and things like that. But that's going to be something which is going to be a permanent thing. And pharma, like you said, and IT, where we have an advantage, a relative advantage over the rest of the world. That's also something which would be kind of structural, but it also has its phases of cyclicality. But yes, those two also we think are good sectors to be in. So
Yeah. So with that, we've come to the end of the session, sir. Thank you for your valuable time. So you've answered all the questions. And of course, this webinar is truly a milestone. I would say that you've done it really well, sir.
Okay. Thanks a lot, and thanks to you and also to TVS Bazaar for hosting this. And it's been a pleasure to be chat with you.
Thank you, sir.